What happens if there is an incorrect treatment of expenditure, and how will this affect the accounts of a business? I'm Thomas Harwood and welcome to The Accounting Student, where we create free and short videos so that you can learn about accounting. Today's video is looking at the consequences of incorrect treatment of revenue and capital expenditure. To start with, expenditure can be referred to as a payment or agreement which in return a benefit, asset or service will be received. Expenditure can range from anything from water and electricity bills to the purchase of a new car. As there is such a variety of expenditure, it is useful for a business to categorise them into particular groups, as these will be treated differently in the accounts. In accounting, expenditure can be distinguished into two main types, and they are known as capital expenditure and revenue expenditure. Capital expenditure is recognisable when a business spends money on fixed assets, additions to a fixed asset, or to get a fixed asset in a position to be ready to be used. Additionally, capital expenditure has no relation with the owner's capital account, as capital relates to the owners and the owners only, and capital expenditure relates solely to the business. On the other hand, revenue expenditure is recognisable when the expense is incurred in running the business on a day-to-day basis. It is extremely important that there is a correct distinction between capital and revenue expenditure, as this is essential to determine an accurate and fair value for the profits and assets of a business. In the accounts, any expenses relating to the capital expenditure will result in increased figures for the fixed assets in the balance sheet, and revenue expenditure is chargeable to the profit and loss account. If there was a scenario whereby the classification of expenditure was incorrect, then this will adversely affect the profits reported as well as the value of the assets and capital in the financial statements. Let's have a look at an example to show the consequences of incorrect treatment of revenue and capital expenditure and how this will have an effect on the accounts. Harry owns a factory producing children's toys. He has some machinery in his factory which each manufacture different types of toys. One of the machines is due for improvements. Harry called the engineer in to improve the speed in which the machine produces the toys. In the end, Harry had to pay £4,000, which included £2,500 for the improvements of the machine to increase the production time, and also £1,500 for unexpected repairs for the machine. Harry decided that the whole £4,000 is capital expenditure, as the £4,000 is being spent on the fixed asset. Therefore, the value for machinery has increased by £4,000 in the balance sheet, and as a consequence, the financial statements look to be in a stronger position compared to the position before the improvement works. Unfortunately, Harry has incorrectly treated the whole £4,000 as capital expenditure, causing the profits, machinery values, and balance sheet position to be overvalued. Instead, Harry should allocate the £2,500 relating to improvements as capital expenditure, because this is causing the machinery to contribute more productivity to the business and therefore enhancing the value to the business. And the other £1,500 for unexpected repairs should be allocated to revenue expenditure, as this relates to the day-to-day operations of the machine in the business. So in the accounts, the correct accounting treatment will be £2,500 allocated in the balance sheet in the existing total machinery account value, and the £1,500 will be allocated to the profit and loss in the repairs account value. The difference between Harry's treatment and the correct accounting treatment is that the balance sheet and machinery value for Harry was overstated by £1,500. Instead, this should have been allocated to the profit and loss account in the expenses section in the repairs account, causing the profit value to be £1,500 lower compared to Harry's profits amount, which was overstated by the same amount. So that was the explanation of the consequences of incorrect treatment of revenue and capital expenditure. If you enjoyed it, press the like button. If you have a question you want answered, leave it in the comments below and we'll try our best to answer it. And if you're not already subscribed, make sure you click on the red subscribe button to keep updated with the accounting student. Thanks for watching, we'll see you next time.